Obviously, crypto market has been reeling as a result of what's happening with the global macro situation and, of course, the contagion from Luna, 3AC, Celsius, and on down the board throughout CeFi. Now, as I like to do in situations like this, is call in guests who probably have much better perspective and much more information than I do. So today I have Jeff Booth, Simon Dixon, Caitlin Long, and Dave Weisberger. Absolutely the greatest of A teams. I'm not sure who would be BA Baracus, but the greatest of A teams that I could possibly put together in this moment. I can't wait to hear their perspectives on everything that's going on with the market. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of All Streets. Before we get started, please subscribe to the channel. And if you're feeling so inclined, push the like button, tap it, touch it. I don't really care how you do it. I'm contractually obligated as a person on YouTube to tell you to hit the like button. Now, as I mentioned before, I have an absolutely all-star panel today to discuss what's going on in the market. And we invited these particular people because they each, I think, have different insight into the situations that are happening. I'm just going to go ahead and bring them right on, not dispense with the niceties, I guess. I've got Jeff Booth, Simon Dixon, Dave Weisberger, and Caitlin Long. Welcome, everybody, and thank you so much for taking the time. Listen, as we get started here, I want to start with Caitlin. Caitlin, you came on in April, and you sat here with Mike Alfred, who obviously shared the same opinion with you, Bill Barhydt, who I would say was sort of in the middle because he obviously has a platform called Abra, and Alex Mashinsky. And you, I would say, pulled no punches with what you thought of what was likely to happen with Celsius. And top to bottom, it completely came true within months. So A, I would say, can I borrow your crystal ball? Or B, maybe I would say, was it so easy to predict that we didn't need a crystal ball?
Well, look, I don't take any pleasure in anyone's pain, and there are a lot of people in pain. And I give you credit right now for being open and honest about your own personal situation. This is no fun for anyone. And I wish it had never happened. I really go back to first principles. To me, it was very obvious from the very beginning. When I started ringing alarm bells, writing in Forbes it was summer 2018, the event that triggered it was when Backed was announced, right? This is, the core of Wall Street, Intercontinental Exchange, which owns the New York Stock Exchange, announced that they were getting into Bitcoin. And I started writing a series of posts for Forbes saying this is bad because it's the bad type of financialization. We want serious adoption that is consistent with the ethos of Bitcoin. And these folks are going to come in and apply fiat thinking, leverage thinking, Wall Street games to Bitcoin. And that is exactly what happened. And it was never going to end well. Bitcoin inherently doesn't have yield. So if you're going to have yield on Bitcoin, you have to ask yourself, where is it coming from? And when I challenged Alex on your show back in April, and I challenged him on a podcast prior to that as well, it was all about first principles. It was not about predicting the timing. It was not about the actual mechanics. It was all about first principles that Bitcoin and leverage do not mix. They should never be mixed. And here we are, unfortunately. And it's not over yet. And I say good riddance to it all because the whole thing has hurt Bitcoin.
Okay, well, obviously you're saying good riddance to it all, which means that I would just imply that you believe that CeFi either is on the way to being out or should be. Simon, I would imagine you have a opposing position because you are, and to your credit, are working very hard to make people whole. Certainly with Celsius, you've proposed quite a few different ways that could be done. And I know that you're a very earlier investor there. So I would love to hear your perspective, which may not exactly line up.
Yeah, line up, but probably different results. So, to full disclosure, I have tens of millions of dollars currently that I can't withdraw from Celsius. I'm a shareholder. We've got approximately, at the last valuation, that shareholding was worth $170 million. It's probably back to when we originally invested, if not a little bit less right now, if not zero. And that's what I'm trying to prevent at the moment. So that's the disclosures. I originally invested in a way of taking out dollars by locking up your Bitcoin and putting a percentage of your Bitcoin at risk under full disclosures. And that was what I originally thought was a good idea. And so we started out with the Celsius seemed like had an idea of a peer-to-peer collateralized lending marketplace. And then what happened and what transpired over time is it turned out that as more and more coins were added, it turned into an unlicensed securities business because it turned out that as long as it's backed one-to-one, you were investing in the management of investment decisions of the Celsius team. Now forward a little bit further, and it's suddenly turned into hacks, money's missing, losses, mistakes made, and suddenly you're in a fractional reserve bank. So I saw that transition, and we tried to support Alex in turning Celsius into a securities business. So at BnkToTheFuture, we have securities licenses. And so we spent about 2 years trying to make sure that the difference is that it went from a bunch of people that, were locking up their Bitcoin to try and get some dollar loans, and people that were trying to take a percentage of their yield and put it in custody in order to receive yield, to persuading a bunch of people that they should take their money out of a bank, purchase stable coins, and then it was considered and pitched as a low-risk savings account, which is completely disingenuous and not reflective of the reality. Now, if it was a security, we have to do disclosures, suitability requirements, test that you understand the risks, make sure that they're only investing a certain percentage, investors that can afford to lose that money, and full disclosures. None of that happened. And then if the worst that it gets to is if it suddenly turns into an unlicensed bank because it's no longer backed one-to-one, then you don't have any of the things that Caitlin probably has to comply with in the business that she's building that has taken years and years and years. And she doesn't even want to rehypothecate, is my understanding of the business as well. So that's where we are. So what I've immediately sought out to do is, when I saw the systemic nature of this, sadly, I was actually passing the death of my father when this actually came and happened. And I had about 3 weeks where I didn't have my phone on. And I came back and just was hounded by direct messages and a realization that Celsius, you could no longer withdraw. So immediately I had to come out of mourning. I put together a multi-billion-dollar syndicate. I put together a bunch of plans because we already had worked on the Bitfinex hack recovery plan, which was a very well executed plan. And my goal now is to try and get it back to the basics principles, turn that back into a securities business, or if it's going to be operated as a bank, make sure that it's operated in the correct way, with the correct team, with the correct people, and try and bring it back to first principles. And then suddenly, because we put together this, we got the calls from all of the different distressed companies. And right now, my priority is making sure that investors and depositors know the current situation, know what Chapter 11 means, and prevent the next set of cascading, and put together, protect the depositors first. And if we can protect the depositors, then there may be something for shareholders. And that's currently the situation I'm in. So doing a bit of a roadshow. And thank you for inviting me to the show.
Of course. So even with your perspective, where you're actively working on a bailout or a restructuring, it sounds like you believe that core CeFi model that we were experiencing is effectively dead. The hunt for yield through centralized authorities that are utilizing your money as collateral to go earn that yield is irresponsible and finished. Jeff,
I think that a security that allows for the concept of a peer-to-peer collateralized Bitcoin loan is a good idea if disclosed, if transparent, and people understand the risks.
Accredited investors, right? Understood. Jeff, where do you stand?
Yeah, I'm totally with Caitlin, and I do feel terrible for all the people who've lost money on this and thought they were in a safe investment, and it turns out they weren't in a safe investment. But if you just look at first principles, this applies broadly to crypto as well, all crypto except for Bitcoin. Bitcoin doesn't have any counterparty risk, and in building a blockchain, I think the simplest way I can think about explaining a blockchain is the design principles of a blockchain, you can solve 2 of 3 sides of the pyramid: decentralization, security, and scalability. But you can only pick 2. And when Bitcoin came in and solved decentralization and security, what it created is a base layer of money that was unhackable, gets stronger and stronger and stronger and decentralized. And it also created a lot of wealth. But it also created an attack vector for Bitcoin from a whole bunch of other things that could solve scalability and sacrifice decentralization or security. By doing so, they had to. And so every one of the other coins is decentralized, is either centralized or insecure by nature of design over time. And you have to ask yourself a simple question at the end of the day. If it's going to be centralized, why wouldn't you use a database? The economic reasons for running a blockchain fall apart if you're going to centralize it. It doesn't work. So the scalability in Bitcoin comes on the second layer and third layer and all of the stuff that comes on top. And so I've never been in the other coins just from a first principles basis. And the same thing applies to leverage, because if you're building something on top of something that's insecure or centralized by design, then you're going to have to trust that the rules are going to change. And those rules changing look like the system we live in today. And so then I go in a broader picture and say, the system we live in today, people are worrying about the unwind in crypto in general and what its effect on Bitcoin, unaware that the exact same unwind and its system effects times a million is our existing system we live in. The only difference in the system we live in is there's a central bank that'll socialize losses when banks get into trouble from over leverage. And the system has always worked that way. And it's worked that way because gold backed it. And then it created an incentive to leverage gold and then make gold a smaller portion of the holdings and centralize, and then remove gold and just have fiat for that credit. But that relied on a central actor socializing the losses when things failed. And that's the way our system works. Our entire system works today. So when I think about Bitcoin, I think about, why would we redesign the system to look exactly the way it looks today? And then, what Caitlin's talking about, kind of this new build, changes all the rules in finance. It really does. It changes all the rules in finance. So people playing games on Bitcoin with no counterparty risk, and attaching that Bitcoin to other things to play more games, are essentially, they're playing with fire. And all of them are super dangerous. Yes, you can gamble and make some money in the short term, but it's just gambling. And most people don't know they're gambling because these look like authentic companies, and they are for a while, but they're not long term. From a first principles basis, they cannot work. They will fail. And why I say that, Scott, is no matter what you think of the company, fear and greed drive markets. And if you're going to trust an actor that centralizes things to be able to drive that, they will always tell themselves a story to build more and more volume and take risks. And they centralize by design.
Dave, you're muted.
I am. Can you hear me?
You are unmuted.
Okay. Sorry, you muted me. Okay. Look, I think that Jeff and Caitlin have valid points that are getting conflated with other points. There's Bitcoin as a base layer for the Internet of Value is something that we've talked about. The last time I was on, we talked about Mark Yusko. I completely, fully buy into that potential future. To be blunt, Bitcoin trades like an option on that outcome right now because it's way too small in terms of market cap, as the base layer would be worth dramatically more. And, that's just reality. I mean, we're talking something that would need to be in the double-digit trillions of dollars of value to actually serve that purpose. And frankly, I think it will probably get there, but that's a completely separate issue. And I don't want this to devolve into Bitcoin maximalism versus are there other use cases for blockchains. That will be an entirely separate conversation that could take hours, frankly days. But what is relevant are two people have mentioned the word first principles. So I'm going to do something crazy. I'm actually going to mention what those first principles should be. Number one, disclosure, right? Let's get to the right camera. The first thing is everyone said, well, people can't know. Jeff had a little line in there that I violently disagree with how you reacted to it, Scott, which is the notion that people can't understand. I hate the accredited investor rule. I think it is discriminatory. I think it destroys individual agency, and I think it is of the worst paternalism that is the response to the original Great Depression. And the reality is of course, what happened, the response to the Great Depression over time have been co-opted to reinforce an elite system that disenfranchises the poor. And the reality is that Bitcoiner should immediately assume that accredited investor is a terrible idea. So let's just dispense with that. And let's understand that if you say that the world should be disclosed, then let's look at things in the world that financialization can do that are good and things that financialization can do that are absolutely horrific. I totally agree with Caitlin in terms of what she was saying back. I don't know about Celsius, and full disclosure, Celsius is an investor in CoinRoutes and Celsius is a client of CoinRoutes. And so I will talk literally zero about Celsius in particular. But what I can say is, having spent a significant amount of time at 2 Sigma and sitting next to the people who made us go from one prime broker to multi-prime, and understanding counterparty risk is something that people in crypto literally didn't. I mean, right. With all due respect to most of the people who have been gracing the stages of consensus and every major conference, apart from Caitlin and Max Boonin and Sam and a couple of others, most of them are fools when it comes to the financial system. I've forgotten more than most of those people know. And it has pained me for years watching people ignore counterparty risk and ignore yield risk. Let's talk about what actually happened in a sense, because the fact is that the way that financial securitization works and the way that loans work in the financial system, in the system that Caitlin decries, with lots of good reason to decry it, this is not an attack, is that we have a cabal or cartel of banks which controls security financing. So whether that security financing is stock loan or interest rate swaps, which are multi-trillion-dollar businesses, by the way, interest rate swaps is, there are huge class action suits that have been going on for a decade about how this cartel controls access to the profits that accrue to people who are loaning things out. There are valid reasons to short stocks. There are valid reasons to do interest rate swaps. There are valid reasons to do repos. There are many valid financial reasons. I'll explain this in terms of crypto. If we didn't have rehypothecation of Bitcoin at all, and we didn't have the ability to deal with that, then what you would have is a system where, let's just say there are 10 exchanges in the United States that are regulated, and more or less there are 10 or 11, depending on what you think of a couple. The fact is, the arbitrages between those exchanges used to last for minutes and used to be double-digit basis points wide at all times. Today, that arbitrage is milliseconds to seconds, and are single digit to sub basis point wide. Why? Because people can move coins from one to another. They can borrow them when they need to. And this is not just Bitcoin. This is all of crypto, but Bitcoin in particular. And because a company called Fireblocks convinced the exchanges to agree to zero confirmation movements because they trusted their network. But that still required the ability to have coins to be able to sell when the price got too high, and have dollars or credit to be able to buy when it gets too low. That arbitrage function is very important, because without that, retail investors get hurt, and they get hurt constantly. And, we fight in the world of equities. I know we disagree on this one, Caitlin. This is a matter of value. But I sit on the equity market structure committees. Even still, people keep asking me things. And there are people who have enormous arguments. I mean, massive lawsuits. We're talking multi-billion-dollar companies fighting over fractions of basis points that Citadel or Virtu might be making on the back of retail orders. Within crypto, it literally has 2 zeros on the end of it. in terms of what retail gets charged and how they get hurt. I mean, the average retail person pays somewhere between 50 and 100 basis points to transact in Bitcoin today. And that's better than it used to be. Whereas in equities, they pay almost nothing.
Dave,
And
I hate to interrupt, but Caitlin and Jeff both had a very visceral and visible reation to what you were saying before. So I have to let them. I have to let them jump in.
Sure.
Caitlin,
do you want to go first?
Sure. Look, with all due respect, that's fiat thinking, and it's applying the old traditional financial services thinking to Bitcoin. Bitcoin is fundamentally different. My first principles are all Bitcoin principles, not first principles about traditional financial markets. And I'll quote Nick Szabo, who blew my mind at I think it was the most important speech of last year, which was the Miami Bitcoin Conference of 2021, where he laid out that you do not need liquid markets. So you're absolutely right that all this rehypothecation and slicing and dicing and securitization and all this financialization that was brought from Wall Street into Bitcoin trading markets definitely collapsed the spread and reduced execution cost for retail. That's correct. However, at what cost to Bitcoin adoption? We have now all these bankruptcies that are occurring because of all the rehypothecation that took place. This is wrong. People got their pockets picked. Some people won from it. You're absolutely right. But Nick Szabo's point was liquidity is a nice to have, not a must. All you need is a way to exit when you need it. That doesn't mean that you're not paying high fees when you exit. Liquidity is absolutely not a requirement. And go back, everyone, and read and watch Nick's speech from the Bitcoin Miami conference last year, not the most recent one, but last year. And I want to throw in also, Jeff made reference to scaling. I deliberately chose this T-shirt today. The hardcore Bitcoiners will recognize it as the T-shirt from the Montreal Scaling Bitcoin Conference in 2015. And I wanted to, again, go back to the Bitcoin first principles. Why is Bitcoin anti-fragile? Precisely because it's designed without counterparties, with decentralization for devolving power to the individuals, and applying all the Wall Street thinking to the secondary markets of Bitcoin corrupted those secondary markets. For those who are not familiar, though, I want to make it very clear, Bitcoin itself is just fine. It's immune to all of this crap.
Completely immune.
And it doesn't care.
But that's really important, because the point that I was trying to get to is that Bitcoin, first of all, it's outperformed lots of high tech stocks, and lots of other assets for a very good reason. The only reason Bitcoin has even been sold during this is because it could be, because it was a liquid asset owned by people who did stuff that they shouldn't have done. So I actually don't think that what's going on in these markets Bitcoin is only tangentially involved. It's basically was the collateral. And if anything, it's proving a point. But the point that I was trying to get to was the reason that Bitcoin, you could stake it to get yield, was because people needed to borrow it. Look on Aave, look on Compound, and see how ridiculously small the yields are back to on Bitcoin right now, because nobody needs to borrow it. And that's actually market dynamics at work. Bitcoin would be completely unaffected by everything Simon is going through, and lots of it is terrible, both personally and professionally. And I feel for you, Simon, because it's, I understand viscerally, unfortunately. But the absolute reality is what has hurt people had nothing to do with Bitcoin. It was people who, maybe Bitcoin was the gateway drug, but it had nothing to do with Bitcoin. It had to do with the chase for yield. It's right, but
to your point, Dave, sorry to interrupt, but you said they needed to borrow it, but they only needed to borrow it because we created the same problematic financial system that we already had. You only need to borrow it because you're trying to behave like the legacy financial system.
Has arbed that out. There is no more need to it. I think Bitcoin
right. Well, you're saying at that point.
So Dave,
right now
I suspect that's going to happen again. That whole thing is going to happen again, and it's going to happen in every cycle here, because people can make a lot of money on the way up by creating these. So there's going to be new coins that are going to do the exact same thing in different regions.
And by the way, Jeff, I don't disagree with you. In fact, Caitlin, you and I are almost in complete agreement. I hated with a toxic, fiery passion the world non-dilutive capital, with response to the ICO boom. I thought that was just horrendous in so many ways. And I remember at the time, in fact, I even commented to you, Caitlin, on LinkedIn on some of the things you said where I violently agreed with what you were saying back then. I hate the reality of what's gone on with NFTs. And although I see a lot of potential, I also see ridiculous, ridiculous pyramid schemes going on. Right. So I think
go ahead, Simon.
Do you want to? Okay, let me chime in. So again, this comes down to disclosure, right? We're free market people. If you believe that you should only hold your Bitcoin in cold storage, just like I do with the vast majority of it, then that's what I do. If I want to take a percentage of my Bitcoin, lock it up, just to get some dollars out, and someone else wants to speculate on it, as long as there is full disclosure and I know that I'm investing in a security, then it doesn't really matter what our opinion is. It's just a free market choice. Where the problem comes, and again, don't feel sorry for me. If I lose everything I've got in Celsius, my financial, I've still got my cold storage. And I knew what I was doing. I knew that it was a percentage of my wealth. The bit you need to feel sorry for is the people that are DMing me right now saying, I put my whole savings in Celsius. I can't pay for my operation. I can't pay for my child's college fees. And I'm committing suicide and considering suicide because I can't disclose to my partner that I've just lost the entire Wells family. That's the problem here. And that's what I essentially need solving, because if everyone knew what they were getting into, then they could decide, okay, well, I knew that this was highly, if I put all of my money into an ICO and I lose it, well, tough luck. But the messages from people that had zero no. Yeah.
Let me come at this from a really high level into Bitcoin and the system that we live in today, and why what you just said might be really confusing for most people. So all money is information. We actually don't want more money. We want what we believe more money will buy us across the board. We want to know how much we have and how much we need to achieve our outcomes in the future. Some people's outcome is safety for their family. Some people is retirement. Some people is so I look really good to friends because I drive a nice car. But it's information that tells us that and what we need to achieve our objectives. That's all it is. So why that's a really important concept is when you have misinformation in the base layer, as we do today in broadly society, the entire market function is when 12 people will press a button and destroy currency. Every house value, everything is based on misinformation of somebody granting power to somebody to socialize losses and save a system from spectacular collapse. Because if they don't, the entire system falls to the ground globally. So everybody's waiting right now as the Fed says they're going to tighten. If they continue to tighten, everything fails globally. Everybody's waiting for them to back off and loosen. That's the world today. And if they continue to tighten, your bank wouldn't be there anymore. Major banks would all fail. Everything would fail. So we all know that's the system we live in. We grant that system a central authority to say, save us, which creates more problem. And that save us, which everybody's waiting for right now in the global market, is essentially create more misinformation and money. Now apply technology to that misinformation. Twitter, social media, YouTube, everything else. And when you have misinformation and money, which is just the thing that's connecting us, trust, connecting globally society, when you have misinformation and you automate misinformation, it explodes. And the world is looking through that misinformation bubble. And Dave was right in how early Bitcoin is, but it is actually truth. And it's really early, and it's not this existing system with all this misinformation. It's a new system. But now imagine all of the people that are looking through the misinformation bubble, and they see somebody getting really rich in DeFi, and they're trying to escape a system that they know is corrupt. What will they do? They'll race into it. They will race into it globally. They're trying to escape a system. They don't want more money. They want to escape. They want to escape. They want to have enough money to live, feed their family, food. And when they see a whole bunch of people getting rich in a system with misinformation at the core, They want to try to get enough of that to escape it too. So you could just through, if you understand human nature, if you understand what will happen as a result of this globally, you're going to get this building up over and over and over again. Well, Bitcoin just keeps on block by block, moving the system over to a new system that is priced totally different.
And Jeff, that is the first principles, and I think we're all, probably everyone in this panel is all in agreement that the fiat and banking system is a derivative of gold, and you've got these cycles that, because of the emotions of fear and greed, drive these cycles, and now we're at the end of a debt cycle that will drive probably the central bank digital currency market as the last resort to bail out the system before it returns to probably a hard money gold system. And we're going to
this is where I think most people are wrong in a hard money gold system. The difference with the hard money gold system, and now to do a hard money gold system, you would have to believe that Russia, China, and the US are going to agree without a war to calculate who has what gold and to trust that, and then everybody else will follow suit on the same. That seems a pretty difficult agreement today, especially when you have a native digital currency from the bottom up technology that essentially gives you unlimited velocity in money. Gold required a credit-based system because you couldn't get credit, you couldn't drive velocity in the economy fast enough by moving gold. It required centralization. The difference with technology in Bitcoin is it doesn't require centralization. The technology provides unlimited velocity. And what I just said there changes all the rules from how things looked in the past. And for the people that understand that, it's why they're building on this and why the counterparty risk. And by the way, I think you guys know, I started a venture capital fund in this space, and I'm investing in layer 2 and 3 solutions right now. So I'm seeing all of the stuff that's coming on top of Bitcoin. We've seen 260 companies. We've already made commitments on our first 3. I'm not going to say what they are right now. My God, some of what's coming that people don't know about, that's going to bring on the next billion people onto this network. It's unbelievable, super exciting. But that ability to build on top of Bitcoin didn't exist for a long time because it was decentralized and secure, and they focused on the first layer. So the second layer and the third layer and everything else that was able to be built on top is only just starting to emerge. People are looking at this asset class like it's always going to be like this. And instead of understanding it looks a lot like TCP/IP.
Can I jump in here and just lay out that we've been beating around the bush about something that is an age-old debate, and it's the free bankers versus the Rothbardians. And I think Jeff and I are more on the Rothbardian side, and the others are more on the free banker side, making the argument that if people want to take risk, then they should be allowed to. The Rothbardian answer to that, and this was where Rothbard, the one thing that he justified, in addition to allowing the government to be able to provide a dispute resolution mechanism for things like fraud that are affronts to property rights, he justified the banning of fractional reserve banking. And this is the debate: is if people want fractional reserve banking, should they be allowed to take that risk, as long as they know it? And here's the problem that I see with that argument. And we've been beating around the bush around the disclosure. That is the problem. How many people walked into this not fully understanding, because there was no disclosure and they had no experience to understand what little disclosure there was. And those of us who were screaming, these yields look high, but they're not high enough to compensate you for the risk. You didn't know at the time whether they were remotely high enough to compensate you for the risk. And it turns out that even the 90% yields were not high enough to compensate you for the risk. You were picking up pennies in front of a freight train. And as Andreas Antonopoulos liked to say, 8% yield today, 0 tomorrow on your principal. You lose it all. And I think that's right. And this is the core of that very debate. I definitely agree with Jeff, switching back to the velocity of Bitcoin, that he's absolutely right. that the velocity of Bitcoin, you can get velocity of money without leverage. And the fiat thinking is that the only way that velocity comes is with leverage, because the settlement is so slow. I don't agree that a credit system had to be built on the old gold system. I don't agree with that at all, because any supply of money is sufficient. But the critical point is that because settlement was so slow, because you had to move it physically, that we developed this credit system of paper where the paper was easier to move than the physical. And that is not true in Bitcoin. And that is indeed what is different about Bitcoin. That is why Trace Mayer was right to call it the apex predator of finance. It is absolutely different than anything that came before it. And by trying to rebuild the fiat system on top of it, it just proved that it is indeed the apex predator. And for those of us who understood those first Bitcoin principles and lived by them for years, we understood that it was inevitable that all these leveraged companies were going to fail. The free banking model was not going to work because there is no lender of last resort. And unfortunately, a lot of people who didn't fully understand those risks got burned, and that's terrible.
By the way,
yeah,
even if there was full disclosure,
just on top of
ahead,
that,
Simon.
this is the difference between fractional reserve, which got me into this in the first place, fighting against the horrors of fractional reserve for 2 decades now, is different from a peer-to-peer lending model. And so I was very, very excited about a peer-to-peer lending model, because I believe that if these are over-collateralized and fractional reserve is illegal, then see, many people confuse that debt is not the problem in itself. It's money created as debt that is the problem, that causes the ability to create debt based upon things that don't exist. But we can't say, take out all leverage, take out because there is a hard money back system. And if you are over collateralized in Bitcoin and you have hard money, and if you want to do something with that, then that is something that, a valid service can exist. Now, unlicensed banking versus a security where it's one-to-one, I think, that's an important distinction. And that is essentially all the cycles. Mt. Gox was an unregistered, unlicensed bank because it bought, because Mark Capellis bought an exchange from the creator of Ripple that had 80,000 Bitcoin missing and then lost a load more. And that created cycle 1, and then Willybot and everything. Cycle 2 was everyone decided to create their own money with the ICOs, and then then slaps up everything that comes from that, and now we're in cycle 3, which is but the important part is distinguishing between the fractional reserve and then risk based upon collateral and actual hard asset behind that.
Simon, if I think about what you just said, and I think about Bitcoin and tied to my book and everything else, we know, so everybody nods their head when I say technology is deflationary, and exponentially so. In fact, the faster prices you move prices up, the free market has to reduce prices faster through technology to stay solvent. Is that fair? Everybody agrees with that and nods their head?
Since 1790, yeah.
Blink twice.
Since
Blink twice
70,
if you agree with this.
since 70, actually, since before that, since the dawn.
No, of course, I know.
And so what sets up short and long-term debt cycles is that same thing, because what it presupposes in inflationary monetary policy is it presupposes you can stop that. And why those cycles used to, in Roman times, used to stop every 600 years, and now they stop every 50 years, is because technology is moving faster one way, and any inflation rate that tries to stop that must transfer wealth from the middle class and poor to the rich. It must concentrate risk. And so if that's true, and everybody nods their head on why that is, but then goes directly back to, we can live in a system that looks like that. Oh, okay. And then what you just did, Simon, on the peer-to-peer network is tied to that. That means that what Bitcoin will do, no matter what, is all prices forever will fall against Bitcoin. That's what it means. Because it's neutral money, it's a neutral reserve asset, and all prices, now there you'll have fluctuations like daily or weekly or yearly, but on the long term, all prices will fall forever against Bitcoin. And that also means if you do, but just one quick thing, Dave, that means if you take a loan for your Bitcoin, that means the real interest rate of that loan is punitive. It's going to be staggering.
Right.
If somebody
Look,
takes
there's a lot going on here, but I just want to object to one thing and make it point, because the notion of fiat thinking that Caitlin is accusing me of, it actually bugs me, because it's not true. Fiat thinking is the belief that you could create money out of thin air because some bureaucrat decides it so, and assigns values to it because they have guns to back them up. In some countries that works reasonably well for now, although is certainly fraying, and I don't think will last forever. That's the US. In other countries, it has spectacularly failed. It continues to do so. The notion of a modern financial system that actually has some value, however, isn't fiat thinking. It's a modernization. In the early days of the Industrial Revolution, people who wanted to build things couldn't. You could save and whatever, but if you try to get a loan back then, it would be tough. Payday lenders and stuff have always paid upon the poor. The reason we have usury laws are because borrowing money for people who need to borrow money to go from paycheck to paycheck or to start a venture is tough. The ability to borrow is not evil. The ability to leverage and do bad things with it, however, cycles. So we saw in the 80s, we saw the junk bond crisis, and people started piling in, reaching for yield. And what did they do? They started buying more and more. And what did Milken do? He said, well, you know what, if we package these things together, we can decrease the risk like magic, except for the fact that the risks were correlated to each other. And so it didn't work out too well. Long-term capital basically levered up what were safe trades, or theoretically safe trades, in terms of very small variations, and levered them up massively and got buried. People have done the carry trade for years between various countries.
But Dave, everything you're talking about, the credit was the debt was never reset.
I agree, Jeff.
So
look,
technology was driving prices down.
There's a reckoning coming, and that's what you're saying, and I think you're right.
And
what
all
we're
that
talking
happened
about now is what do we do in the short term?
But all that happened is you moved the debt from the bank or the private enterprise and the business to the government. That's all that happened, and it grew bigger. And that socialization of losses took money from some people and gave it to others. That's how the entire system works. And today, what Russia just said is, you can't print energy anymore. You can't press a button and print energy. Energy is more important than your paper money. And energy is going to win, by the way. And so the whole thing all over and so now U.S. faces a choice, so U.S. can tighten, and not save Japan and the EU, and that whole thing spectacularly collapses as Japan, and then Japan is going to have to try to sell the bonds they own of the U.S. to be able to save their economy. You're going to run into hyperinflation there. Same thing, energy crisis coming to the EU, and what's going to happen in food crisis, energy crisis around the world because of this problem is so painful. It's going to make what happened in Bitcoin and crypto look like child's play.
Well, that was my point. Actually, is coming around to it is that we're seeing a microcosm of problems as we try, and the companies you're working with and what Caitlin's trying to do in terms of Bitcoin adoption to get people to understand the importance of sound money is vital. Where we've got ourselves into trouble, and I say ourselves meaning the society, is people ignored principles of things like, well, why is a yield higher and what is underneath it and what's going on, and believing people who made false statements. I mean, let's not kid ourselves. I mean, if it wasn't for the Luna crisis, we probably would get another year or two before this all unraveled, but it was going to unravel, and that's the point. You don't think so? You think it was?
No, and here's why, if I could just jump in, and respectfully, I think we're defining fiat thinking differently, because what I'm defining it as is an understanding that something can be created out of thin air, which is the free banking way of thinking about things. And we heard it from Simon. With all due respect, you said we could end up with a peer-to-peer system with over-collateralized Bitcoin. That's the fallacy, because by definition, nobody's creating any more Bitcoin. No one can create more than 21 million, ultimately 19.1 million now. And if someone is over collateralized, by definition, someone else is under collateralized. And by definition, therefore, someone has bankruptcy risk, and it's all going to come unwound. That's the problem with the free bankers way of thinking. There is ultimately bankruptcy risk in it, because ultimately there will end up being bankruptcies, and innocent people who didn't understand the risk that they were taking are going to be caught by that. There's another really important point that I want to throw out, though, which is that I'm not anti-leverage. I'm anti-circulation credit. And this is again related to what we're dancing around here. There's a huge distinction, and Mises, I wish had flushed this out more. But there's a huge distinction between two types of leverage. One is commodity credit, and the other is circulation credit. Commodity credit is lending based on production that has already taken place. In other words, up to 1-to-1. And then circulation credit is lending above that. The circulation credit is where you get the fractional reserve banking. And so absolutely, I don't have a problem with folks borrowing up to 1-to-1 collateral. The problem is, and this is where the fiat thinking comes in, is that the leverage leaks into the system, because while it might look like you are solvent, at an aggregate level in the system is not solvent, because by definition, if you're over collateralized, somebody else is under collateralized, and somebody has bankruptcy risk.
I want to jump in very quickly. We keep talking about the idea of disclosure, and I think we're giving, unfortunately, people way too much credit. I think if every disclosure was there and everyone was honest, people would still be greedy and wouldn't dig in, and we'd still do the same thing. It's like the old South Park episode where it's like, why won't it read
the emotions of fear and greed are never going to change, but you can build it into the user interface. At BnkToTheFuture, people have to pass a quiz to know that they can lose all their money, to know that there's dilution in equity, and they can't continue unless they do that. So these disclosure can be built. It's not the legal agreements. It's you can build better UIs in order to.
Right, but Simon, to your point, you talked about
even if you play, even if you play that, everybody presses, I'm going to give Google all my data.
Except
they don't want
you just accept the terms and conditions.
It's exactly. You don't even you never read it, and and they could change the terms
when you have to pass on BnkToTheFuture.
Simon, I don't think he's speaking specifically about that, but yeah, that's my point. Is we go back to Simon, what you were saying. The real problem here is your average person in X country who doesn't have access to a banking system, who uses this as their bank account, and sadly, that person, would have to pass your test. That's good, but that person, no matter how many disclosures you offer, is going to say yield. And I trust this platform because so many people are using it and so many billionaires have advertised it and are invested in it. And so that was the same thing with Luna.
Yeah, but
there was all this hubris.
The alternative is
you're doing the right thing. I'm not arguing with you at all. I'm saying, but the amount of hubris with Luna was because of how many billionaires were behind it, how many funds.
Right.
Was
Scott,
but the alternative to the free market is tell everyone that you're only allowed hard money, right?
I absolutely agree that you're doing it the right way. That's not, certainly not my point.
I mean, look, creative
Scott,
destruction is part of capitalism, right? I mean, we all hate to look at it. Jeff's made a really important point here, which I think is the point. I mean, which is, do we as a society want a system that socializes losses, yes or no? And if the answer is yes, then at that point, are we better off? If we're going to socialize losses anyway, then I agree with Jeff and Caitlin almost full stop. I personally think socializing losses is a horrible idea. I think
Dave,
that
keep going on that. Keep going on that, because what that means when you do that, and this is what in the ideologues that run the world right now that people don't actually understand. You know this, I think, but when 80% of your tax revenue comes from inflation instead of taxes, right? When that happens, when that happens, and you don't have a vote in how much you're being robbed by inflation. You have no vote in inflation. And so what that means, when you socialize losses and you say that's okay for a government, you actually build a fraud into society. And if you build corruption into a base layer, then you'll get corruption everywhere. And so the worst in human nature will come out, chasing money into a system that's based on a fraud. But democracy and communism, or capitalism and communism, look exactly the same under that model. I wish they didn't, eventually they do.
But let's be fair. The evolution of capitalism towards once you employ socialized losses, you're no longer capitalist.
Totally.
You're
you
no
don't have
longer
creative
free
destruction.
market incentives. You're no
you
longer
don't have-
individual choice,
exactly.
because the choice has been taken away. That's your point.
Exactly. And that creeps into every other economic decision. Houses look like that today. Everything looks like that today. Based on when is the market going to save us and print more money and socialize more losses? And that's the middle class and poor falling into suffering everywhere else. That's it, negative externalities. We look at it through a US centric lens or Canadian centric lens. And what we don't realize is we're the beneficiaries of that system for a while. In Africa and South America, or they're the externalities of that system. They're the periphery. Right. And what's happening is that periphery is now going to turn into Japan and the EU. And the choice is going to be every man for themselves, because that's what it. But that system died a long time ago, because it's but there's a whole bunch of people in North America who believe they live in a free market system, and they're fighting wars to save a free market system that is no different than a centralized.
I want to be really, really clear here. I mean, I don't, on the philosophical level, on the where we should go level, on those, you and I are like not on the same page, or on the same sentence, maybe the same word or pixel. I agree with you. I'm merely saying that when you look at the current market and you try to figure out what scaffolding do we need to get from there to where we want to go, maybe part of me, I mean, I never thought of myself as an optimist, but I guess compared to you, I am, which is kind of crazy. I think that there's either the fourth turning style, massive unrest, war type scenario for a new system around Bitcoin to rise, or we can figure out an incremental bridge to it. And if we can figure an incremental bridge to it, then we're going to need some financial scaffolding.
Let me jump onto that, because actually I'm a massive optimist, but I have to be a realist to be able to understand first principles, where we are, what human nature looks like around the world, what we're playing against, to be able to get to where I want to spend my time. I believe that people, all of us, create our future by our actions. And I could either give the existing system more energy and play in that game and spend all my time with politicians and everything else in that exact game, or I could, which cannot, because it's a structural problem that cannot be solved from the system. There is no way to solve this system from the system. Or I could spend all my energy building a new system that every single node, every single new person that built that bridge to the other side is actually making the bridge stronger for everyone else to walk across. It's an emergent system. And you're right to say the market is mispricing it, because the market is pricing it from the existing system. It's an emergent system that is getting stronger every single day. And if you see the technology that's building on top of it, that are going to give hope and prosperity to the world, to totally change out of this dystopian future, it's super exciting. I want to spend all my time there.
Yeah, Jeff, you made me really excited now. I'm really interested in what you're investing in. Like, what are you seeing now? These second layer and third layer, they sound amazing.
Yeah, so
we've been waiting a long time, man.
Yeah, and again, I understand the economic rationale for why everybody built on these other entrepreneurs went on something that you could build on with smart contracts, unaware of the base layer of the risk of that, because at least they could build on something. Once the entrepreneurs went there, they had a vested interest to sell their thing, and protect the foundation that they were built on, not because of bad people, bad intention. It's just that they could build businesses there, and then early on, those businesses did really well because they didn't know it was building on a pyramid scheme that would fail. But what's happening now, if you look at the ability on Bitcoin, just starting early, to be able to build on top of that layer, wow. People should do a lot more work and see what's happening. What's happening there, because it's a really exciting future. 1 billion people on this network in 24 months.
And I'm so excited about it for Custodia Bank as well, precisely because of what Jeff is talking about. You still need fiat on off ramps, though, and we've designed Custodia Bank to be different than all the leveraged players that are collapsing around us as we speak, precisely because it's designed with the non-leveraged Bitcoin ethos approach to solvency. We care about solvency more than we care about liquidity. It's very much a model that is consistent with the way Satoshi conceived. But yes, of course, it's fiat because it's fiat on off ramp. And that's what we need to be able to come into this system. But to Jeff's point, the things that Custodia Bank are looking at for our planning down the road for after we finally launch related to layer 2 and the emerging layer 3 are so exciting. Absolutely. One last quick thing before we close in the last few minutes. I think what Simon has done in the past with the bail-in at Bitfinex that succeeded is worth talking about, because the financial distress costs, and again, I think the two of us agree and two of us disagree on the whole free banking model. But one of the problems with the free banking model is that you will inevitably have failures. And I think we're all in violent agreement they should be allowed in capitalism. But ultimately, then, how do you deal with the cost of financial distress? And so could I turn it back to him to talk about the benefits of pursuing a bail-in structure, whether I would argue that it is socializing losses, but it's only socializing losses among the customers of that one company, as opposed to socializing losses across the whole economy. And is that a cheaper, better way to deal with financial distress?
I think this is a really, really good point. And I do want to hear a lot more about your bank. And I had a question for you if we've got time, but let me go into that one.
I have 15 more minutes for anyone who wants to stay, by the way. I know we're about to leave, but if any of you have to go, please do. And Simon, continue.
All right. Okay. So yeah, when you hear the word bailout, then you think of government, you think of socialization, you think of tax, you think of inflation, you think of theft, you think of all those types of things. But Lehman Brothers collapsed, and bits of Lehman Brothers were swooped up by the free market, and bits of all the other banks were socialized and went into that system. So when people say the word bailout, they think of a government. Now with Bitfinex, it was right. Everyone that was speculating on Bitfinex had a bunch of dollars, had a bunch of Bitcoin. It was easy in those days. They created an Omni token, which was built on top of Bitcoin. And they said, we owe you, can you believe 119,000 Bitcoin was only 72 million? That at that time, 72 million was this astronomical number. It feels like just like something so small compared to what Ethereum created. But it was this astronomical number that we thought, oh shit, we've got Mt. Gox all over again. And so what Bitfinex did is they created an Omni token, and it was $1 for every dollar. So they had to say, all right, here's the price of Bitcoin. So when people logged in, they had 33% less of their dollar or Bitcoin balance, and they had this token. And everyone was saying Bitfinex is a scam, give me back my Bitcoin, all that stuff. But immediately that token, people could dump it at 30 cents on the dollar. And then speculators came along and said, well, I'll buy $1 worth of Bitfinex debt at 30 cents. And then at BnkToTheFuture, we launched an equity pitch where you could take that token, buy it at 30 cents on the dollar from someone that really thought Bitfinex is a scam, this is never going to recover. And get $1 worth of equity in the future. And so people were buying it at 30 cents. Then that pushed up the price. They started trading, repaying. Now, if you remember at the time, this is when Tether first started getting traction, because a little startup called Binance didn't need any banking, didn't need banking facilities because they were using Tether. And then suddenly this became this multi-billion-dollar stablecoin thing built on top of Bitcoin. And then that actually provided trading revenues. They repaid about, we converted about $55 million into equity, all free market. Those that didn't dumped and created a loss. Those that speculated got $1 worth of equity. And those that just held it and repaid got their debt back. But the equity holders on the BnkToTheFuture secondary market, it traded at a peak of $16. So they went from 30 cents to $16 when the market boomed again. And they paid out 2 years worth of all their profits in dividends. And they got the ability to have a right in the recovered Bitcoins, which recently this year, $3 billion was recovered from the DOJ. So that was a free market solution with risks, proper disclosures. Only the people that are allowed to invest in securities that were investing in those securities, those that were allowed to take on the debt, and people deciding what they wanted to do. I just think it was just a really elegant solution, and I can't see the negative externalities in that.
Hey, Scott, can I go back to something that Caitlin said right before Simon started talking? And I want to bridge it to what Jeff said. I think we'll get a lot closer to agreement after this. Yes, I think so. When I talk about financial scaffolding, what I'm talking about, Caitlin mentioned fiat on and off ramps, and Simon mentioned the fact of how important it was for people to be able to buy their houses, cars, pay for their kids' college, etc. If we're talking about bridging to the future, then when I talk about the need to decrease execution costs, being able to get into Bitcoin and out of Bitcoin, sure, most people think of that as speculators' ability to have more velocity, but it also has direct impacts on people's ability to use Bitcoin as a store of value until they need to actually spend that value. And that's kind of the point that why essentially that's the reason for my whole company, is basically to help people buy and sell cheaper, because right now we have a market structure which is sort of run by speculators and greed and fear and all of that. But the absolute reality is fiat on and off ramps exist until such a time as we end up with peer-to-peer transactions, which I think will happen. I mean, I think that globally, I think it's extremely important for people not to have to bring their Bitcoin back into currency. And there's 217 fiat currencies. I don't know what the number is, but it's a large number. At a certain point, some of them are trash, and people are already using Bitcoin for it. At the top end, people are still. You have to get it back on and off to fiat. And a large part of what we are talking about is Simon and I basically focusing on a model that will bridge to a future where we're more like Star Wars, where or it's not Star Trek. Even there, they still go between credits and gold press latinum and all sorts of stuff. But in every version of a utopian future, you have a sound money that everybody agrees with, that can't be controlled by a central authority and printed away. And that's what we're all about. And I don't think there's a lot of disagreement about that. I doubt there's any in this panel. But how we get there, I think we need to be able to have low costs for doing that, and we have to have fair, I don't want to use the word safe, but fair, well-disclosed, well-understood risks in the system. I wish we could legislate that away, I really do. But, being old and having seen the crash in '87, having seen, the aftermath, because of portfolio insurance, which was completely ridiculously sold, having seen Orange County and LTCM in the '90s, having seen the global financial crisis, and, so many different, Asian contagion before that. It's just, these cycles repeat. And yeah, Caitlin's right. These cycles repeat. And I know that there are people who wish that we could legislate that a world. I think our fundamental disagreement is I just don't think we can. I think what we need to do is to try to improve it incrementally each time. And I am not convinced that we're improving it incrementally each time. I think, and I forgot which one of the three of you said it, I think that I think Jeff did, that the can that's been kicked down the road in every previous crisis is getting bigger and bigger and bigger. And at some point, we're not going to be able to kick that can down the road.
I think everyone knows that. It leaves us, listen, we've got a few more minutes. Simon, I know you said you had a question for Caitlin as well. She asked you about, Yeah,
let's try and bring it full circle. So, I think this is, so in 2010, I tried to create a bank. I went to the Bank of England. They said, firstly, you're not allowed to be the CEO. It's got to be an executive from a bank. They also said you need 60 million deposited in the Bank of England. And they said you have to build the technology on top of the existing system. So even if you custody, you've got to custody with another bank, and therefore you're rehypothecating by default. How have you got around this, Caitlin?
Oh, well, it's different in the US and we're not operating yet. Obviously, it is disclosed our situation with the Fed. And we're now 20 plus months into that process.
And suing.
I didn't want to say it, but yes, indeed. And So obviously stay tuned on that. We can launch and are planning to launch soon with a correspondent bank. And that correspondent bank is not going to be a 100% reserve bank. And so, yes, it is a.
There's no escaping. That's my point, right? And that's what we
until one of us gets a Fed master account, and there are multiple people in this industry that are pursuing that, and so obviously stay tuned. But there is a really important distinction, though, the digital asset custody business that's part of our business plan that was approved when we were chartered is designed for non-leverage. Rehypothecation is a felony in Wyoming. It was actually really funny because for the longest time, BlockFi, the only state they were not willing to make loans in was Wyoming because of that Supreme Court case that concluded rehypothecation is a felony in Wyoming. To my knowledge, it's never been challenged. But I'm waiting for someone to challenge whether that's actually felony fraud in Wyoming. It could be an interesting case. But nonetheless, it's actually in the statute. So Dave, this is an interesting point. I think your philosophy values liquidity over solvency, because once you go down the path of favoring liquidity, which I hear you, there's definitely a benefit to that. But in a market where, by definition, anyone who's providing leverage, the circulation credit on Bitcoin is creating fractional reserve Bitcoin, that inherently means there's insolvency that is enabling that liquidity. And my philosophy is very different than the philosophy of the Wyoming statutes, and the philosophy of Custodia Bank is favoring solvency over liquidity. We have a very different view. And that's because ultimately, I think the balance sheet is the most important financial statement. And so much of the fiat thinking in the world has cast aside the balance sheet. Look at the whole West Coast model of venture capital. They don't care about balance sheets at all. Some of the big companies in our industry have been running at losses deliberately to try to build network effects, because they think that the way Amazon built their business, which is constantly running at losses, but building big network effects, is the right approach. The problem is this is all ultimately going to be regulated by financial regulators that are applying an East Coast model. And those companies that have been operating at losses, even if they're not operating on leverage, I think are going to end up with a big comeuppance, unfortunately for them.
Can I just, the one thing you just said, because there's so much, I wrote extensively about network effects, and then a lot of people talk about it because it's 70% of all technology value is in network effects. And most people misunderstand network effects. Network effects are when every additional user drives more additional value to all other users. That's what a network effect is. It's not just growth. And so a lot of these, by definition, so Ethereum, Raul, who read my book 3 times, talks about all of the network effects there. By definition, if it gets weaker and weaker or more costly for all users, for other users, it's not a network effect. You can drive a whole bunch of money in there or a Ponzi scheme, and it looks like it for a while. Just like in '99, a whole bunch of people said they had network effects and were just Me Too clones of Amazon that didn't have network effects. They were marketing ploys. But a network effect by definition, and Bitcoin has 2 really strong network effects, really strong, because every additional user makes the network stronger. And on the Lightning layer, it looks like the same as a peer-to-peer transaction layer. So those 2 network effects are reinforcing on each other. And most of the rest of the industry does not look like that.
Yep. Yeah. And for the record, Caitlin, I agree. That is what in Latin we would call stasis, where you and I disagree, and we could talk about why. And who knows? I mean, we might even get closer in terms of on the edges. But the truth is, the network effect versus the MLM kind of scheme is a very big difference, and people don't understand it. I think, Jeff, you encapsulated it perfectly.
But guys, listen, I would love to have this conversation for 10 hours, but I know we all need to go. But I want to do like 2 more minutes before I jump. And very simply, should these CeFi companies be bailed out or not? And what do you think that looks like in the future? Very quickly, like 30 seconds each. Jeff.
No. I'll rest of my 30 seconds go to others. Absolutely no.
Ivan? I think we know you're
yeah, I'd like to have a free market solution for those that are willing to take the risks and the risks are disclosed.
That makes sense. Caitlin?
No, absolutely no.
And
I
Dave,
mean, I completely agree with Simon. I think those who have an enduring value proposition in a business that can actually return value should survive, and those that can't should be flushed.
I think makes perfect sense. Thank you. But by the way, Simon, I want to be clear. I totally agreed with your with the idea of letting people actually take a quiz and prove that they are that they are competent. I was not trying to dispute that point at all. I love the perspective here, and I appreciate everybody sharing. I think that it's very interesting when we all sort of, I think, come to the same conclusion, even if the thinking is different. And so I appreciate all of you being civil and having this very, very important discussion, as a lot of people obviously are suffering through everything that's happening here. Guys, everyone, I will be back tomorrow, of course, at 9:30 a.m. And I'm actually, the reason I have to jump right now is I'm going on Crypto Banter right now to completely lose my voice here. So thank you, Jeff, Simon,
Thanks,
Dave,
guys.
Caitlin. This has been absolutely amazing. All of you are welcome
Scott.
back, of course, anytime. Thank you once again. Bye, everyone.
Thanks, everyone.
Thanks all.
Let's go.